Hello, I'm Chris Pedersen and this is Stockwatch on Wednesday the 6th of March 2024. All advice is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here I did a summary of the past 6 months. These are the top stock performers that I've given you on Stockwatch. But the best performers are James Hardie, RWC, West Farmers, New Farm, News Corp, and the list goes on. This is significantly better return than you would have gotten just buying the ASX 200. Here are some winners and loser performance statistics. Companies making a profit, 34 of my selections. Companies that are in a loss, 14. This is an excellent ratio. By the way, this excludes companies that I rated neutral or had no opinion on. And these are based on prices as of Friday, March 1st. Here are some of my market observations. India GDP is at 8.4%. That is massive. It is the world's largest in terms of population, and now it has extraordinary GDP growth. But bear in mind, it's off a low base. The Aussie consumer is slowing their spending. However, it is not collapsing. They're still spending. Our GDP is still growing, although not as fast as it has been the past few years. The reporting season profits. Now, this is a very interesting statistic. 17% up for miners. However, non-miners, the profits were flat. That is very significant. Key numbers from results. Outlook statements, well, 18% were positive, 19% were poor, and the rest were in line. Revenues. The revenues, 23% were increased revenue expectations, and on the negative side, 58 expected revenues to decline. That is very disconcerting. Net profit after tax was positive with positive result, 42% of the companies, and a poor earnings per share, 25%. Dividends per share was 35% positive, 35% neutral, 29% negative. So in terms of dividends, it was kind of line ball. What you want to do is you look at companies that are raising dividends and make sure they're sustainable. Here are other statistics that you can look at your leisure. Iron ore futures versus China stock market. Well, as you can see, the iron ore futures on the right have been declining because the price of iron ore is declining. The China shares, well, that market has been in decline for quite a few years now, and I don't see any stimulus to turn it around right now. Copper prices. These are US dollars per pound. This is very significant because copper is in the news. A lot of people are looking at copper. They're trying to extrapolate going forward. These estimates are from UBS, and I took a long time frame. But what you see here, 2019, the price was $2.73 per pound. Then in 2020, it was about the same at $2.80. However, it jumped the next year. This is the first year under COVID, up to $4.22. Since then, it's been relatively stable. And if you look going a lot further out to 2025, it's at $4.50, which is a decent increase, but not that significant. 2026 is up, but then 27 and 28, they're expecting it to decline. This is the copper demand by sources, a nice little pretty pie chart for you to look at. And this is China use in transition. Well, what you see in the light red, light brown, is the use of copper for green energy purposes, such as more electrical wires, motors, etc. This page is very significant. It shows copper global supply versus demand. In 2019, the negative 292 means that there is more demand than supply. There is a shortfall of 292 kilotons. But when you go further out, what you see is that in 2022, it was in surplus. 2024, it's a huge deficit, and that deficit just gets bigger. What is that telling us? Well, on a pricing basis, we should expect that the price of copper will soar. However, history tells us that when the price of copper starts to go up, suddenly there's a lot more supply available for the market and it goes back to equilibrium. This is why UBS is saying that going further out, like 2027 and 2028, the price of copper is going to decline some back to $4. That is not because of current estimate, but because they know historically that large price rises in copper create a lot more supply to satisfy the demand. This is a chart that I thought you'd find very interesting. It has nothing to do with finance, although it sort of does, because obesity drugs come into play. The dark red countries are ones that have a high level of obesity. You look at the United States, that's not too good. You look at Australia, oops. I mean, we might not have a lot of obese people in certain areas, but as a country, we're eating too much. Now, 3 companies I want to cover today. First is Sandfire Resources. The reason for this one is it's a copper miner. Take a look at the 5-year chart. It's kind of been not moving all that much, up and down, but now it's breaking out on the upside. It is at $7.83. You can see on the right how it's ticking up. Let's take a look. Is this sustainable or not? First of all, I have a 12-month price target of $7.75. Then if we look at revenue growth rates, which is very good from 2023 to 2026, it's 10% per annum. That's excellent. Earnings per share during that same period is growing at 35% per annum. However, that is off a very low base, so it's deceptive. The dividend growth rate, it does not pay dividends. Now, if we look at PE on the 2025 earnings estimate of 25 cents, it's a PE of 31 times. That is expensive. For a miner, that's expensive, and for Sandfire, that's expensive. The yield on the 2025 dividend, well, there is no yield because they don't pay dividends. Free cash flow is negative until 2025, so that's not too good either. And the payout is not meaningful. Sandfire is a Perth-based copper company. If copper rises to $4.50 per pound, then the net present value of Sandfire should rise up to over $11 a share. That looks attractive. However, it might be a while before that actually happens. Until then, I would rate this company neutral. A lot of miners and copper companies, they have a lot of volatility. They're caught in cycles. This company really, if they can't pay a dividend, I'm just not so sure about it. It is hot the past week, but today it's down. I don't know if this big rise is going to be sustainable. Cleanaway Waste. Code on the ASX is CWY. It's trading right now at $2.57. This 5-year chart shows you that it's going nowhere. And on a numbers basis, well, 12-month price target, I have it as $2.55. I expect it to continue going nowhere. The revenue growth rate is very low, 3% per annum. Earnings growth is pretty strong at 23%, but that's off a low base also. And the dividend growth rate, 17%. But let's look at how it's valued overall in terms of the ratios. The PE ratio on the 2025 earnings estimate of 11 cents is 26 times. And on a yield basis, I'm expecting about a 7-cent dividend in 2025. Well, that's only 2.5% yield. Free cash flow is 3%, and the payout ratio is around 65%. This is a waste disposal company for residential and commercial. I feel they have too much debt and interest costs. In addition, they have labor problems. They haven't been able to solve these problems yet. When they do, it might be a buy, but it's not there yet. I rate it neutral also. Last company is South32. This company is a spin-off from BHP a long time ago. The code is S32 on the ASX, and it's trading at $2.89. Look at the chart. The past year, year and a half, this company has been a huge disappointment. Everybody keeps wanting to get invested because it's bottomed out and will continue to then turn around, go up to where it used to be. Well, I'm not so sure that's going to happen. I have a 12-month price target of $3.60. That is a little bit low compared to other brokers in town. But I don't have confidence in S32. The revenue growth rate for the next 3 years is 0. The earnings per share growth is 12%, and the dividend growth is 14%. These are also off of a low base because of COVID. The PE on the 2025 earnings estimate of 23.5 cents is 12 times. Now, that's in line with how miners should have a PE because of the cyclical risks to them. The yield for the 2025 dividend of 9 cents is 3.1%. That's okay. Its free cash flow is 5%. The payout ratio is 41%. They're a diversified miner. I do think it's a good company, but I would wait until they start performing a little better. The share price has to bottom, and if I give up 10% of the upward move, that's fine, but that is a better time to buy than right now where it's continuing a downtrend. As always, if you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au and address it to me, Chris Pedersen. Thank you for your time, and I hope you have a profitable week.